Hi, I'm Jim Cunningham, and we are going to talk about using charitable trusts to save taxes and make the most of your philanthropy. So, on a very high level, this is about having less go to the government, right? Ultimately, and redirecting those dollars to charity and redirecting them for something other than just handing it over to your state taxing authority and the federal government. So, a lot of people are interested in this. I'm Jim Cunningham. I'm a partner at Cunningham Legal. I have 30 years experience as an attorney. Our firm has offices throughout the state of California. I'm a certified specialist in estate planning, trust and probate law, a real estate broker, securities and insurance licensed, and a pilot single engine land instrument rated, and a lot of time in a Cherokee 6. A lot of lawyers in our firm helping typically the mass affluent clients with estate planning, real estate needs, getting that wealth from one generation to the next while minimizing taxes. And very important, I'm a lawyer, I'm talking, my lips are moving, words are coming out of my mouth. This is not legal advice. Please do not take it as such. And this is information only. A lot of this is not do it yourself. So really, you want to get qualified advice before you just go out and do stuff. And if you're watching this on YouTube, we're doing this live, but if you're watching this on YouTube, please subscribe to our YouTube channel. Well, welcome, Caroline and Tay. I'm really excited to talk about you. I'm excited to hear about 10,000 Degrees, and we're going to talk about why consider charitable giving. Why should people even give to charity? So, Caroline Silverstein is the Chief Development Officer at 10,000 Degrees, and Tay is the Director of Philanthropic Giving at 10,000 Degrees. And I will let you explain, the two of you, what is 10,000 Degrees? What's going on? Why? We have you on here because I really want to give some context. So when people talk about charity, like, where's the money going? Why should people even donate to charity? What good are you doing in the world? Just help educate us.
Well, thanks so much, Jim, for having us on today as your guests. So at 10,000 Degrees, we believe strongly that receiving a higher education is the best way to break the cycle of intergenerational poverty in our society. And that unfortunately, there is an educational opportunity divide. There are a lot of barriers in place to obtaining higher education, and that's especially true for students from low-income backgrounds and students of color. And so at 10,000 Degrees, we are all about supporting students from low-income backgrounds with scholarships that are paired with near-peer financial aid advising, college advising, transfer support, and we are doing it at scale. We were founded in Marin County over 40 years ago, and now we are supporting 4,200 students this year in college across 8 Bay Area counties, and we reach another 12,000 students in high school with our advising and workshops on financial aid.
Wow,
So that's a little bit about us.
that is so wonderful. I got to tell you, my own background is my grandfather was a member of the United Auto Workers and a tool and die maker in Detroit, working for General Motors. He put 3 boys through college, which is amazing. Now, it was the 1950s and early 60s, but that, I will say, the education is a game changer and is a multi-generational, lasts multi-generations. So what you're doing is a tremendous investment for the United States, quite frankly, for California, for society at large. And I know many of my clients are very fired up about supporting education. So what a great thing to do for people. So there's a feel-good chemical. I mean, why do people give? I mean, tell me, what do you see from your donors? They feel good about it, right?
They do feel good about it. And I think that, I think that there's a few reasons. I think that people see the power of education in their own lives, in their families' lives. A lot of our donors recognize that they wouldn't be where they are in their life if it wasn't for education, if it wasn't for a mentor, if it wasn't for somebody believing in them. And I think that that motivates a lot of people towards giving. I think the other reason that people give to 10,000 Degrees in particular is because we're we have a strong track record. We're established. We've been serving the community for over 40 years, and they believe that it is a good investment with their charitable dollar.
Yeah, it's interesting. You point out here less than 15% of American households itemize deductions and 60% of Americans give to charity. This is very important. If you have an IRA and you're 70 and a half or over, or know someone who does, stick around because we get some really good content. It's a way to basically still support charity and pay less tax, even if you don't itemize your deductions. So you definitely want to stick around for that. So I'm going to tell you a little bit about because I went to the 10,000 Degrees Gala last year, the event. And one thing that really resonated with me is what you do is you take these dollars and, in my view, you multiply the dollars. So you're helping people with a scholarship, but then you're also coaching and mentoring them to get all the other scholarships that are available out there, right? All the other financial assistance. And it's just tremendous. It's a I think, very unique because people can give to an institution. You know, I'm a graduate of University of California. You can give to UC. They've got that thing. But this is interesting because you're applying this to individuals. And then what schools are they typically going to? What are you seeing?
So we support students on all pathways. About 40% of our students first go to community college before transferring to 4-year, and about 60% of our students go directly to 4-year. A lot of our students choose to stay in California. It's got a great, public university system, and that, I think, for the free financial aid that's out there, that is, a very affordable way. So we have a lot of students that go to school within the CSU or UC system, but we also have students that choose to go to public universities around the country or private universities. The students make the choice. What we try to do is give them full and complete information on the financial aid. And as you said, to try to leverage all the free financial aid that's out there. So in addition to the $8.6 million in scholarships that we awarded last year, this is where what we talk about when you say really leveraging the dollar. We leveraged $42.3 million in financial aid. And what that means for our students is that they're graduating with less debt, 87% less than the national average. And that has a huge impact on what we talked about with breaking the cycle of intergenerational poverty, but also in the choices that they can then make in their careers post-college.
Yeah, and many times I think if there's one person in a family who breaks out, that may be the only person. Now, sometimes you get more people, but I think a lot of times their families really rely on them, and have to have that boat anchor of student debt it's tough.
And we've seen so many times where students then inspire their siblings, their cousins, their parents to then to go and get their higher degree. So it can really be kind of like a change catalyst and change agent within the family.
So I mentioned worst first. So there are in our income tax system is progressive. So what that means is the more you make, the more you pay. If you make less than $27,000, you actually get money back, right? If you're very low income, you get a check. You're not paying. You're getting money. But there are as you earn more, right? As you have more taxable income, the rate that you pay is more. So if you make $100,000 a year, you're paying less on that $101,000, right? The next thousand than if you made $1 million. So if you make $1 million and make $1,001,000, your tax rate is higher on that higher amount. When you make a charitable contribution, if you itemize your deductions, if you're one of the 15%, then that does come off your highest tax bracket. So it doesn't come off your blended rate or your average rate. It comes off your highest tax bracket. So if you're a California resident and you're in a 50% tax bracket, which many of our clients are, when you give $1,000, it's only costing you $500. And so effectively the government is subsidizing the gift to charity. And you can see here the graduated tax rates. The projected tax rates, remember, these are set to sunset. These are married filing jointly. So we are slated without any further government bill that's passed that a president will sign, and whoever that person is, it's going to be one of two people. And a lot of people want one person to be president, and a lot of people want the other person to be president. We don't talk politics here, but we do talk reality. Unless a bill is passed and signed by the president next year, we're going to have a 39.6% federal tax bracket for tax year 2026. So those are going up. Estate tax exemptions also. Estate taxes are going up. So the amount you can leave tax-free is 14 million, is 13.61 million this year, probably 14 million next year. Kind of reading the tea leaves. That's 28 million per couple. That's going to get cut in half, adjusted for inflation. That'll be probably 7.2 million. So again, and the tax rates are going up. This is if nothing happens, if no bill is passed that the president signs. But we have an election, right? We have an election on November 5th, and we will have a new president. And Elizabeth Warren's estate tax proposal, just so people understand this, this is something I believe the Harris-Walz campaign has adopted. And what they're looking at is reducing the estate tax exemption to 3.5 million, and then a 40 to 65% tax rate. And again, this is a graduated tax rate. So 40% up to 10 million, 45% to 50 million, 50% to a billion. I mean, you get to billion, 10 billion, and 65%. And there's not many people out there with a $10 billion estate when they die. But bear in mind, we don't know what's going to happen, right? And it also includes the elimination of many tax planning tools. I don't see charitable trusts being attacked. I think the qualified charitable distribution, which we're going to talk about, is still in the cards. So how do charities use the money? What do charities do? They get money. And again, we talked about you're helping scholarships, but let's talk about what should people look at when they're giving to a charity? I know a lot of people want to know. A lot of people say, I will not give to a charity if they use more than X percent on whatever the number is. If they use more than a certain percentage for things other than charitable purposes, that would be like overhead and marketing, and maybe unpack that a little bit. What are you seeing in the charitable space?
Yeah, thank you, Jim. 80% of the money that we do raise goes to scholarship and programs for our students. 11% go to administration, and only 9% goes to fundraising. Last year, however, we have about 8.6 million in renewable scholarship that we gave to our students that Caroline talked about earlier. Now, a lot of organizations do give scholarships, but we like to say we give scholarship and support. We give scholarship and support through our fellow programs. We do have a near peer mentors. That's the support that we do give that assist these students that are embedded in high schools and colleges. So that's how we use the money.
Yeah, and interesting, this is charities have to report data in consistent ways. Okay, I'm just broadly speaking. So they have to report it uniformly, right? But what I'm also hearing is you had provided 8.6 million in scholarships, but you were able to leverage another, what is that, 40 million, or what was the number?
42 million.
So really, when you look at the total benefit going to the students, it's not 20% that's being used. It's probably closer to 4 or something, isn't it? I mean, when you look at the overall benefit going to the communities you're serving. So and this is why I have you on our webinars. I think you guys are doing great work. I think not only are you able to take a donor's dollars and get them in an efficient way to people who need it, but you're also, 4Xing, 5Xing, 8Xing, whatever it is. And that's why I wanted to have you on here, because you guys are you're doing great work. So there are public and private charities. So there's a big divide. Public charities, you guys are a public charity. Private charity is a family foundation, right?
Right.
It might be a corporate, if you watch public television, you'll see it's sponsored by this, whatever corporate charity. And there are different adjusted gross income deduction limitations for the private versus the public. So public, if somebody has $1 million in income and they write a check for 600,000 to 10,000 Degrees, they can deduct that 600,000. But if they give appreciated stock of 600,000, they're going to be capped at 30% deduction, and they would carry that charitable contribution into future years. So it depends. And this goes back to what we said, depends on the type of property that's given. Cash is a type of property, and you can take a deduction for the full value of the cash up to 60% of your adjusted gross income. But things that have appreciated in value, different set of rules. So this is why you need to the involvement of your CPA, right?
That's correct.
And what sort of things do charities accept, right? What sort of assets?
Yeah, asset accepted, we accept cash, obviously. We do accept IRA, which are retirement accounts. And also we also accept appreciated stocks. You know, you talked earlier about Apple and Nvidia and Microsoft of the world. So we do accept all those. Now, in terms of revenue, 59% of our income come from grants. And then we do have 32% that comes from individual giving. And I like to spend some time on individual giving, for instance. The individual giving comes from about 1,500 of donor household that do give us money yearly. And also, in terms of the individual giving, we have foundations. You talk about private foundation earlier, like donor advice funds,
Right.
and also corporate grants from companies like Adobe, Warriors, and LinkedIn. And then a special event, you mentioned you attending OAC last year. We get 5% from special events, which are OAC, and we also have, which we usually do last Saturday of April. And then the change maker, we do that in November, like the second week of November. So in total, 59% come from grant income, 32% from individual giving, and 5% from special events.
Yeah, so different sources. And what I want to for those of you watching this who you might be watching this to figure out like, hey, how does a charity work? But also look at that stock gift. By the way, if you have appreciated stock and you make a gift of that stock, guess what? Just turn around and buy the stock on the open market and you'll have a higher cost basis, right? If your cost basis is $1 and the stock is trading at 100 and you give that $100 stock to the charity, you just turn around and buy stock for 100. Now your basis is 100. So when you sell that in the future, you're cutting your capital gains tax bill. That's another example of mindful giving. And I think people really don't look at this closely enough. How would somebody go about it if they said, hey, I'm going to give to 10,000 Degrees or whatever charity they want to give to? How does that work? If I want to give some stock, do I call my financial advisor and tell them, hey, call 10,000 Degrees, or how mechanically does that work?
Yeah, thanks. That's great. Usually people are working with a financial aid advisor. We actually have our stock transfer instructions on our website under our ways to give. And it's helpful if people let us know in advance, but they will just transfer, the stocks. We use the Merrill Lynch as our broker, and then we promptly sell the stocks and then let them know what the donation value was. But we have every year, I'd say more and more of our donors are choosing to, I think in most cases, appreciated stock donate to
Right.
10,000 Degrees.
You don't want to sell the losers. You want to sell those because you get a deduction. So just paying attention, like you really want to go through and, the losing stocks, maybe you want to sell those before the end of the year. The winning stocks, you might want to donate those and then go out in the open market if you still want to own that stock and buy it. So charitable deductions, as we mentioned, it's a percentage of your adjusted gross income. So this is your 1040 income, and it depends if it's a gift of stock, appreciated stock, that's typically capped at 30%. If it's a gift of cash, it's 60%. And you really do need to visit with your A team. But we talk about this in other videos, kind of like the A team from the 80s. I don't know if you remember that, but it's the team. They have your CPA, financial advisor, and estate planning attorney, and in this case, maybe a charity, right? Certainly, if you want to make a large donation, let's say somebody wanted to make a donation of $10 million to let's go big. They want to leave $10 million. Would they work with you on how that money should be spent? I mean, are there any ways that they can nudge you on how to spend that money? How does that work?
So as far as estate planning gifts, I've worked with donors in preparing their estate plans in a number of different ways. Some donors choose to leave that gift unrestricted. They don't want to handicap us in any sort of way in the future in how we administer that gift. A lot of times people really like the idea of supporting student scholarships with the gift. And so they will often choose that they want their gift to go to student scholarships. Maybe 80% of their gift go directly to support student scholarships. And then we'll choose the last 20% to invest in our programming, because they understand that our programming is really based on the scholarship being paired with that near peer advising. And I've worked with a lot of donors, and it's a beautiful way to think about your legacy and providing for the next generations of students.
So we're going to talk about the timing and the nature of the asset just briefly. And timing is very important because especially if you don't itemize your deductions, and only 15% of people itemize deductions, which means 85% don't, and 60% of people give to charity. So there's a delta there, right? And we don't really know how the numbers break down. But if you don't itemize your deductions, you really should pay attention to this, because you may want to consider bunching your charitable contribution. So we have a slide here that says, option one is you take the standard deduction, and if you bunch your giving, right? If you bundle it into a single year, you're going to save $7,000. You're going to get an additional $7,000 in income tax deduction, which is going to translate to, money in your pocket. It's a few $1,000s. So very important to think about, if you're giving every year, you might want to put all those into a single year. So instead of giving next year, right, you might want to push all those into this year or push them into next year. But I guess if you're the charity, you'd say, well, it'd be better to push it into this year, right? Because you would be able to deploy those funds quicker. So think about bunching your contributions in one year so that you reach this threshold where you can itemize your deductions and not take the standard deduction. So again, appreciated stock, appreciated real property. Do you guys accept real estate? Have you guys ever done that? Or
yes,
great.
definitely. Usually we've had many people that have left us in their estate the proceeds from the sale of their home.
And then we're going to talk about donating appreciated versus donating appreciated stock versus selling the stock and then making the donation. So somebody says, hey, I've had this run up in NVIDIA. I'm going to sell some NVIDIA and give some money to a charity, 10,000 Degrees, whatever it is. You're better off giving the stock itself than selling the stock, right? Because you're going to have capital gain and then making a contribution. So you're going to not be getting the charity. Basically, government's kind of getting some money on that one, and less is going to the charity and to you. So let's look at some other charitable planning tools and strategies. So we covered charitable trusts, gift annuity. I'm just going to briefly go through these. You might see these, advertised in the newspaper. That is really dating me because I used to read a newspaper and you'd see the ads. A gift annuity is where you say, hey, I'm going to give $100,000 to charity. I'm 92 years old. I'll get $12,000 a year for the rest of my life, but I'm 92. My runway's kind of short, and the charity gets half of that, and that $100,000 gift, half of it sort of statistically comes back to me. Half goes to the charity. That is a gift annuity. So if you've seen those, what it is you're writing a check typically for 100,000, and then you're going to get an income stream for life. The older you are, the bigger the payment, the bigger the annual payment, because the shorter your life. If you're 80, it's going to be less money because you're statistically going to live longer if you're 80 than you are 90. A donor advised fund is typically attached to a charity. A donor advised fund, many of our clients do have these. They're typically the big financial advisory firms. They'll have them. And this is where if it's December and your tax year's ending and you're like, gee, we want to make a charitable contribution of $100,000 or $10,000, whatever the number is. We don't know who to give it to. We haven't figured that out. That's what a donor advised fund is. So you can put that money into a donor advised fund, and then later, and there's no time limit under current law of when that money has to come out. So you can make that charitable contribution, and then the following year or years decide where that money goes. Now, it's key. You're advising the custodian of that money where to go, and basically it needs to go to a 501c3 is kind of the bottom line. So it's got to go to a charity. We're going to talk about qualified charitable distributions. This is very, very important. There's also matching programs with certain employers, and please, pay attention to that. If you do make a gift of stock, there might be a match for that, right? Because you're going to get that letter back saying this is the money, effectively the money we got.
You can really, I've seen so many donors double, sometimes even triple the impact of their donation through matching funds.
So let's talk about, donor advised fund. Here it is. It's an irrevocable tax contribution to cash or security. So you can do this with stock. And, you recommend grants to charities, and as long as it's not too crazy. Generally, you can't direct it. It's not a donor-directed fund. It's a donor-advised fund. So there is a little bit of discretion on the charity. So let's talk about qualified charitable distribution. Qualified charitable distribution, very, very important. This allows you to transfer money from your IRA to a qualified charity. Now, not a donor-advised fund. So it's got to go to the charity. This satisfies your required minimum distribution without adding to your adjusted gross income. This is why this is important, because many people, when they hit their required minimum distribution, which now is 73, you can do this at age 70 and a half and later, but typically we see people doing this a lot with their required minimum distribution. The client might say, look, I don't really need the money that's coming out of my required minimum distribution. I'm giving to charity anyway. Why not give it from your charity? Because if you're not itemizing your deductions and you take a distribution from your retirement account, you have to pay tax on that. And then when you give the money, if you don't hit a certain threshold to the charity, you're not getting a charitable deduction for that. So it makes sense to go directly from the IRA to the charity. Now, this is 100 for 2024. This is 105,000 per taxpayer. This is 210,000 per couple. Now, many people who are our clients, people watching this, might have very large IRAs. It is not uncommon to have a client with a $5 or $10 million IRA. Those minimum distributions are in the hundreds of thousands of dollars a year. Many times the clients simply don't need the money and they really don't want to pay the tax. So sometimes it makes sense to move that money directly from the IRA to the charity in lieu of your minimum distribution, right? Or as part of your minimum distribution. Not included in your taxable income, can help you lower your AGI. The lower AGI can help with the phase out of other deductions and credits. So this is where you get into this complex nature of an income tax return. And if you're phasing out of other deductions, it's like a double whammy. So not only do you have the tax from the IRA, but then you're losing out because your AGI has been pushed up higher. So getting a little in the weeds on taxes. And again, this is why this is the purview of the experts, right? Of the A team. And it maximizes your standard deduction because if it goes from your IRA, it's not included in your income. And it's also excluded. This also can help your Social Security from being taxed. So if your income is a certain level, your Social Security is taxed, and they count the minimum distributions from your IRAs. So really take a hard look at this. If you have an IRA, if you're looking at minimum distributions are already in them and giving to charity, this is really something I would pay close attention to. The people who know about this are typically, well, people in our firm know about this. I would say charities know about it. CPAs tend to know about it, and they're going to be really the people you're going to want to rely on to figure out how much, like the numbers, like what numbers make sense. And I would say most certified financial planners are going to be aware of this, but not everyone's aware of this, right? So it depends on who's your financial advisor. So again, this is probably an A team type strategy. So this counts towards your RMD. It avoids the Medicare surtax, doesn't push you into net investment income tax. So a lot of times these distributions from IRAs, if you have other investment income, can push you into that 3.8% net investment income tax. And frankly, it allows you to give more to charity than you otherwise would. I think this is probably the single biggest untapped source of funding for charity. So if you run a charity and you're watching this, if you give to charity, please reach out to them. And if you had a favorite charity, if it's your church, if it's your synagogue, whatever it is, a lot of times they're just not really aware of what this creature is. And a lot of the people involved with these charities, frankly, have very large IRAs and it can be a tremendous blessing for the charitable organization. I would say what's great about this, it's very simple. The charitable trust requires headspace. Let's face it. You have to do a trust. You got to go with the lawyer, and we're fine doing it. We love complexity. It means more legal fees, I suppose. I don't know. But this is a very simple way of helping out a charity right now. So they're not having to wait for it. There's not a whole lot of paperwork, not a lot of steps. And I will tell you, the older people get, I'm 55 and I'm already feeling this. I want my life more simple. I want less complexity. This is a less complex way to help out charities. There's no deduction limit on the AGI, right? So, if all you had was required minimum distributions in charities or Social Security income, you're not going to be capped, right? So if you took that money out and made the charitable contribution, you're taxed at 60%. And this is why people use qualified charitable distribution. So again, a little bit of time spent on that. And as we come to a close, remember, it's the three-legged stool. And actually, this is like a fourth-legged stool. I tried to work with the graphic on this, and because Ashley, our producer, and I do these slide decks. And by the way, all the misspellings are totally me, because I do this like right before this thing goes out and I change stuff. So sometimes it's misspelled and it's 100% on me. This is a four-legged stool. You got to involve the charity, right? So I want to thank you for joining us today, Caroline and Tay. This has been great. We're going to open it up for questions here. If you have any questions, go ahead and put those in. Our offices are located in Northern and Southern California, Bay Area, Sacramento region, and LA region. And this is the contact information for 10,000 Degrees. I'm going to bring this back up as we do the Q&A, so you've got that information. And the true cost of retiring in California, what you need to know. We're going to cover that September 5th at noon Pacific time. What does it cost to retire in California? A lot of people want to know. Spoiler alert, it's expensive, but it's beautiful. If you can afford it and stay, a lot of people stay, a lot of people go. If you're watching this on YouTube, please subscribe to our YouTube channel. We're going to open it up for questions. If you are watching this on YouTube, magically, another video is just going to start when this one stops, and it's going to stop right now. So thanks for joining us.